in the late 1990s as the Indian stock market was entering a new era. Technology was booming, and one name began to dominate the headlines: Ketan Parekh. He was seen as a visionary, a man who could turn any stock into gold. But behind the glossy media profiles, a dangerous game was being played that would eventually threaten the stability of the entire Indian banking system. Ketan Parekh didn't build his fortune through traditional long-term investing. Instead, he relied on a technique called circular trading. Simply put, this involved a group of interconnected entities buying and selling the same stocks among themselves. This created an illusion of high demand and soaring volume, which naturally attracted unsuspecting retail investors who thought these stocks were the next big thing. To fuel this massive machine, Parekh needed vast amounts of capital. He found an unlikely partner, the banking sector. Specifically, he leveraged his relationships with small cooperative banks, most notably the Madhvapura Mercantile Cooperative Bank. These banks were often willing to overlook risks for the promise of high returns, issuing pay orders that allowed Parekh to access liquidity that shouldn't have been available to him. Parekh focused his attention on what came to be known as the K10 stocks. These were companies like Avtech Infosys, Zee Telefilms, and Silverline. By concentrating his circular trading on this specific basket, he could move their prices dramatically. For a brief period, these stocks defied gravity, seemingly ignoring the broader market conditions and constantly trending upward. As the K10 stocks climbed, the media dubbed Parekh the Prince of the Indian stock market. He became a frequent guest at high-profile events and a consultant to major corporate leaders. Because his trades were driving the prices up, he was perceived as a genius. Investors were falling over themselves to get a piece of the stocks he was touching. But the scheme had a fatal flaw. It required constant, ever-increasing amounts of cash to keep the share prices elevated. If the market turned or if he couldn't find new buyers, the pyramid would collapse. In early 2001, the global tech bubble was bursting, and the sentiment in India began to shift. The easy money that fueled his trades started to dry up. The trouble hit a breaking point when the Madhvapura Mercantile Cooperative Bank failed to honor a massive pay order. Suddenly, the reality of the situation came to light. The bank had issued pay orders far beyond its actual capital, and the money had effectively vanished into the black hole of Parekh's failing trading positions. The news sent shockwaves through the market. When the public realized the K10 stocks were held up by nothing more than circular trades, everyone tried to exit at the same time. The prices of these stocks plummeted, often hitting the lower circuit limit for days on end, meaning shareholders couldn't even sell if they wanted to. The fallout was catastrophic. The index plummeted, and thousands of retail investors saw their life savings evaporate. The scam exposed deep rot within the banking system and highlighted how easily market manipulation could bypass the regulatory safeguards of the time. The Securities and Exchange Board of India, or SEBI, faced immense pressure to act. Following the collapse, investigations revealed a web of shell companies and offshore entities that Parekh used to hide his tracks. He was eventually arrested and banned from trading in the Indian markets. The episode forced a massive overhaul of how the stock market functioned, leading to stricter regulations, better monitoring of trading patterns, and electronic transaction systems. The lesson here is one of transparency and risk. The Ketan Parekh scam serves as a reminder that when stock prices move in ways that defy fundamental business logic like consistent earnings or growth, the reason is often hidden in the mechanics of trade rather than the company's performance. When a system relies on constant new capital to sustain a price, it is not an investment, it is a ticking time bomb.